Good afternoon, ladies and gentlemen. It is July 21st of 2022. My name is Robert Rayburn here at LifePro Asset Management. Now, right off the bat, I'm going to apologize for my raspy voice. I am battling a little bit of a cold, so I'm going to try and keep it pretty short and sweet this week. For those of you who have kids, you'll know that as soon as your kid gets a cold, it's just a matter of time before you go down with the rest of your tribe. And so in my case, it happened to be that my kid got a cold, my wife got a cold, and last but certainly not least, I fell down fighting, but I ended up coming down with the cold myself. So we're going to go ahead and get started. Now, the title of this week's presentation is this the Battle of Midway moment for the Fed? And specifically, the date we're focused on is June 15th. Why is that? It really seemed that something changed on that date. Unlike the previous 25 basis points or 50 basis points rate increases, the Fed will always seem to be kind of fighting inflation in a bit of a timid way. But on June 15th, it was when they really took the gloves off and they said, not only are we coming at you with 75 basis points, we're going to do it again in July, and we're not going to stop until we kill inflation. And their commitment to killing inflation, I think, is being received well in the market. And we're going to look at how different asset classes have behaved since that meeting, what the symptoms of the market are trying to tell us, and more specifically, what it means for your portfolio between now and the end of the year. So a few things we're going to go over this week. What are we watching over the coming week? How pessimistic are investors, even with the recent rally in stock prices? And then lastly, discuss some of the current trading conditions, both the good and the bad. Over the next week, earnings. We're going to have a flood of earnings. We've already had a couple companies report within our portfolio, but we're going to expect much more over the coming week. That's going to give us a lot of clues as it relates to the economy, consumer spending. So far, what we saw with the bank's earnings reports is that the consumer remains very healthy. And this goes to our core thesis that the economy is going to slow, but we don't think it's a recessionary economy. And what we mean by that is 0 to 2% GDP growth, falling inflation, but a robust U.S. consumer that keeps us out of a recession. Number two, the FOMC meeting next week. Obviously, we had big resolve in June. Believe it or not, we don't want the Fed to take its foot off the gas as it relates to tightening rates. We want them to show resolve, because if they show resolve, that means the market can start to price in lower inflation, as we've seen with those one-year inflation swaps. Lastly, we want to continue to pay attention to those technical levels, both pre and post the Federal Reserve. That includes S&P 500 levels, the NASDAQ credit spreads, growth versus value, interest rates, commodities, etc. All of these are really, really important as it relates to asset allocation and whether or not growth versus value is the trade over the next 3 to 6 months. Now, why do we think it's the Fed's moment? When we looked at what they did in June, what happened around mid-June? High yield credit spreads peaked on June 15th. That's right on the Fed's meeting date. Commodities peaked on June 9th in anticipation of the FOMC meeting. Stocks bottomed the very next day on June 16th, at least bottomed as it relates to where they are today. Growth versus value bottomed in late May, ahead of that meeting. And then, of course, Bitcoin, which is literally at the center of the risk storm, it actually bottomed on June 18th. So all of these different asset classes, and I haven't included interest rates, which also peaked in June. So we had interest rates peak in June, inflation expectations peaking in June. All of these things coming together suggest that the Federal Reserve's message was heard loud and clear, and that this was very well, perhaps, their battle of midway moment against the war on inflation. And we see that with credit spreads, right? When credit spreads are widening, that's bad. That means companies have to pay more when they're raising debt. right? Their interest rates on their debt are going up relative to where interest rates are on the US government risk-free rate. So when those are going down, that's a sign of health. When that's going up, that's a bad thing. In fact, we used credit spreads back in 2008 to really help us get out of the way during the intense market sell-off way back then. Now, what you'll notice is this was the FOMC meeting. Ever since then, we've had a sharp improvement in overall credit spreads. Now, as it relates to optimism in the overall market, there is no optimism. And that's what makes us optimistic. So the percentage of investors right now that are taking above average risk has hit the lowest point since October of 2008 when Lehman Brothers collapsed. This is an incredible observation and measurement because not only is this an extreme risk-off environment, but also this is nowhere near as bad as that moment in time when the banking system in the US was collapsing. We have a well-capitalized banking system, a strong US consumer with low levels of debt, and overall, a pretty healthy housing market, even though it is, we think, a little bit overpriced and likely due for a correction. Overall, the economy is fairly robust with the exception of the inflationary surge that we've seen. When we look at equity allocation versus bonds, it's also at its lowest point since April of 2009. So again, almost everyone out there is pessimistic. We're seeing record levels of cash being raised within institutional portfolios. We're seeing risk appetite close to its 2009 lows. What's the common theme here? When you get to these levels, does it make sense to sell stocks or buy stocks? We look at those forward returns off October 08, or if we look at March 09, or we look at May of 2020, it was a time to be an aggressive buyer in the market. Now, doesn't matter what your timing is, we always do recommend, if you're going to be buying, we need you to have that 4-year plus time horizon. So looking at another way, consumer confidence, again, all-time lows. What do you do when consumer confidence is at historic lows? You buy stocks, you don't sell them. And in fact, when we looked at the average 12-month forward return for the S&P 500, when you had consumer sentiment troughs, in other words, low points, the forward returns about 24.9%. During sentiment peaks, when everyone's feeling great and everyone wants to party and everyone wants to buy stocks, that's when you actually get pretty flat returns around only 4.1%. So what's the message here? It historically pays to invest when everyone is pessimistic, not when everyone is happy. Investing shouldn't feel comfortable. And that's really the key here, is that in order to really, at the end of the day, make money long-term, what you have to do is you have to invest in a way that makes you feel a little bit uncomfortable, takes you out of your comfort zone. And that's not something most advisors are going to tell you, but that's something a lot of our advisors coach and preach on a daily basis. So what is it we want to see? We want to continue to see stocks making higher highs and higher lows. The one thing that has been missing is we haven't seen a lot of urgency in the buying. So we do want to see a little bit more panic buying out there. So on big up days in the market, more stocks that are making 2 standard deviation daily moves from a historical standpoint. So what's working? We've seen strong breadth in the overall bounce. We're rallying in the face of deep pessimism. Growth is outperforming value. We as growth investors want to see that. And commodities keep deflating. Oil in that $95 to $96 range this week. Where does work need to be done? That advanced decline line on the NYSE, advancing stocks versus declining stocks, hasn't broken that downtrend yet. So we want to see it break that downtrend. Super important. We need to see more of that panic buying, as I mentioned before. The percentage of stocks above their 10-day moving average is still less than that 99th percentile. When we get a big panic buying moment, you'll see the percentage of stocks above the 10-day moving average in that 99th percentile. We want to see that. And then lastly, correlations do remain pretty high across different stocks and different sectors within the stock market. So what does all this mean for your portfolio and how should you position for it? So right now, what we're seeing is moderating growth. Inflation rates are beginning to fall. Real simple. In this matrix, that means we want to move away from value and economically sensitive stocks and toward growth stocks. We don't think a recession is the big risk here, so we don't need to raise cash or buy bonds. So that's really how we're looking at overall asset allocation. So the bottom line is, what we know is that growth is slowing, right? It's hard to predict the future, but what we can say right now is that growth is indeed slowing and pessimism remains dominant. June 15th appears to be, at least currently, to have marked a turning point in the war on inflation. And while growth is slowing, you can make money in a slowing growth environment. We do that. We recommend that. We recommend rotating away from value and toward growth stocks. And then lastly, what we really like to see here is the stock market continues to climb a wall of worry, but we do want to see a little bit more panic buying on those up days. That's what we got for you this week. We do think the recovery is at hand. We're going to have some chop. We're going to have some volatility and some painful days, but we think that the trend is upward with those higher highs and higher lows. If you have any questions, please feel free to reach out to your advisor or here at our home office at 888-543-3776. Thank you again and have a great weekend. Talk to you later.